1. Interest rates and financing environment. Interest rates remain higher than the ultra-low era of earlier in this decade. This affects mortgage affordability for households, which restrains demand, cost of development and refinancing for real estate projects. As noted, many CRE investors see the high-rate environment as a strong headwind. DLA Piper +1. 2. Supply and demand imbalances. On the supply side, new construction is slowed by high materials/labor costs, regulatory constraints, and financing stress. On the demand side, demand is shifting. For example, aging populations are driving demand for senior housing, work from home/hybrid work is reshaping office demand, logistics and industrial remain strong due to e-commerce. PWC +1. In many residential markets, the inventory shortages of earlier years are ameliorating. More listings, and thus less severe upward pressure on prices. HouseCanary.com +13. Macroeconomic and geopolitical risks. Global growth is softening, inflation still above target in many places, and debt burdens are high. These macro factors create uncertainty for real estate. IMF +1. Geopolitical/trade policy risks also factor in tariffs, supply chain disruptions, regulation. DLA Piper survey cites tariff worries. DLA Piper 4. Sectoral/functional shifts within real estate. The old model of investing in any real estate and assuming value will grow may be less sound. Instead, assets that meet current occupant/tenant demands, ESG requirements, flexible use, digital infrastructure, e.g., data centers, fiber-connected logistics, are gaining. Global English +1. Living/housing markets are being segmented more. Senior housing, multifamily, affordable housing are different plays than single-family detached homes. PWC 5. Regional variation matters a lot. While global summaries are useful, local factors dominate: regulation, urbanization patterns, demographics, interest rates, foreign capital flows. For example, Germany's market is expected to modestly rise but with risk of undershooting. Reuters. Future predictions and what to watch. Drawing from the available data, expert forecasts, and emerging trends, here are some predictions and implications for the real estate market over the near term, 2025 to 27, and medium term, to 2030. Near term, 2025-27, home price appreciation will be modest in many mature markets, e.g., US, on the order of 2 to 4% annually rather than double-digit growth. For example, consensus forecasts expect 3% growth in US for 2025. JPMorgan Chase +1. Home sales volumes should gradually improve as affordability slightly recovers, inventory increases, and buyer competition lessens. For example, the U.S. National Association of Realtors, NAR, predicted existing home sales up 7 to 12% in 2025. Bankrate. Commercial real estate segments that meet strong demand, e.g., industrial/logistics, data centers, modern offices, living, will outperform legacy assets. Investors will increasingly require active asset management, repositioning, or functional relevance rather than just passive hold. Global English +1. Investment capital will stay selective. While confidence is rising, many investors remain cautious given rate risk, economic uncertainty, and structural changes. DLA Piper. In many markets, rental growth, especially in constrained supply locations, may outpace capital appreciation for several years. This means that investing for cash flow, rent, may be more attractive than relying purely on price growth. Medium term, to 2030, in many countries the decade ahead is likely to see average annual home price growth in the mid-single digits, 3 to 6% range, rather than rapid boom.